On this video, we're going to be focusing on all things cash flow. So if you're an investor in the current market in Australia and you're jumbling up whether or not you want to go for cash flow properties, positive properties, neutral properties, or negatively geared properties, this video is exactly for you. Now, I'm a mortgage broker based in Sydney. My name is Adrian and personally I hold 6 investment properties, and we're going to use some examples exactly on myself and my situation. And on this channel we talk about all things lending, finance, and investments. So this is exactly what we do. We put out great content, and let's jump straight into it. So I've got a couple of calculators here that we're going to run through. Now, one is a repayment calculator and two is an additional repayment calculator. So we're going to use me as an example, and I'll put in a figure here which is $3.5 million worth of debt. So just a little bit of background on me. I've got 6 investment properties, and I'm going to max myself out at anywhere from about 10 to 12 investment properties, and that's going to happen. I'm already at 6. I'm buying 7 and 8 in July and August, and most likely I'll be maxed out anywhere up until March or May of next year. All right, the loan situation that I'm going to be in is going to be anywhere around, say, $3.5 million worth of investment debt, and all of that debt is mainly sitting on interest-only variable with an offset account attached to each separate loan. All right, so that's me personally, and bear in mind I'm giving you a situation which is me as a personal investor, and I'm explaining what I'm doing. All right, you always need to be speaking with your accountant or your financial planner and not take this as specific advice, because it doesn't apply directly to you. All right, so in this example, let's go through some of the numbers that we're seeing here. So $3.5 million worth of end debt, and look, it could be 3.3 or about 3.8 depending on how many properties I buy that I'm putting granny flats on the back, and how many properties I'm buying outside of Brisbane. That's going to be the main ones that are going to change these figures slightly, but I always use kind of where I think the number will be, and it should be around the 3.5 million mark, and I'll be sitting on assets of anywhere from about, say, 4.8 to about 5.5 million total. Okay, that's where the end figures will be on the values. All right, so I've got a repayment calculator up in front of me. It's a monthly repayment frequency, 30-year loan term, interest only, 4% rate. Let's hit calculate. All right, you can see that the monthly repayment on interest only on 4% is $11,666. All right, and I'm not sure if you're aware on the types of properties I buy and what I do with those properties, but a lot of my properties are based in Brisbane. I've got one in New South Wales, and really most of my portfolio is sitting on 6 to 8% rental yields. All right, so the cash flow is very high, and I've made a lot of growth on a number of those properties as well, with many of them going over 50% higher than the purchase price that I initially bought them at. All right, so my journey started at the end of 2020, and we are at 6 properties now. In about 2.5 years, we'll get to 8 properties, which will be July or August. All right, and really, let's play around with this calculator, because we know the RBA rates are going up. So I put it at 4%, mainly because I fixed. So what I'm doing personally is, because I'm going so hard and I know I'm going towards my max. Okay, what I've done is I've fixed a portion of my loans for a 2-year fix, because my personal view is that rates are going to go up maybe 1 to 1.5%, and then I think that the RBA and the government is going to truly see how bad the economy really is and business is, and then I think within maybe 3 years we'll be in negative interest rates with printing happening again. All right, at an RBA level, and really we're already seeing a portion of printing with both political parties, Liberal and Labor, printing not from a a job seeker and a job keeper point of view and saving business, but they are printing directly into the property market with their two first home buyer schemes and housing affordability schemes, which is going to really push up prices of property, anything under your first home buyer max. So in New South Wales, that's 800,000. So any property in that kind of 200k range right up into 800k range is going to have a surge of people that are demanding those kind of properties under these two new schemes. All right, so I see that as direct printing into the property market because it stacks on top of all of the other grants that first home buyers get and other people get in the market, which is going to put increased demand out there. All right, so let's say so me personally, I've got at least six of my first four properties are fixed at anything under 3.3%. Some of them were fixed at 2.9. All right, and my fifth and sixth property that settles at last day of June, first day of July, and that's fixed at I think 3.49% for a 2-year fix IO. All right, so really, even if we're accounting for some interest rate increases, half of what I'm going to buy is already fixed at under 4%. All right, so let's say rates go to 5%, then if I fix it at those levels, then obviously the averaged out rate will be 4%. But let's say it's not. Let's say it goes up to 5%. All right, so let's use that as an example. So we go from an $11,600 payment, and it's taking a little bit of time with the calculator. Sorry. It'll load up in a second because I've got quite a few windows open. So right now, let's look at the numbers that we're looking at. So 4% is $11,600 payment. Okay, and if you put that, let's get a calculator out. And if we do 11,600 times it by 12, gives us a payment of $139,000. All right, now I've already costed out the purchases that I'm going to make and what the cash flow will be on those purchases on that total debt level, and I'll be sitting anywhere from about a 350 to 400 grand in total rent. Okay, 350 to 400 grand. All right, so if we're in a position where let's always use the lower end. Let's use 350,000. 350,000, and I've got my calculator out here. And then we minus 139,000 gives us free cash flow of $211,000. All right, and that's at the 4% levels. Now let's run it at the 5% levels. It's just updated on the screen. All right, so we're looking at $14,583 times it by 12 gives us 174,996. Okay, 174,996. So let's do that now. 174,996 gives us positive cash flow of 175,000 at the moment. All right, and that's if rates go to 5%, which I don't think it will, but we'll have to see. And we're talking about the fixed rates, where the variable rates right now are 2%, and really I can't see them getting much more than about 3.5% to 4% as well. So this is a worst case scenario position of 175,000 free cash flow in my portfolio. All right, so you've got to think about it from a Australia point of view. All right, there's all of my debt is investment debt. All of it is on interest only for 5-year period. Okay, and all of it is covered by the rent that I've got, and I've got extreme buffers. All right, so pretty much everyone in the country is going to blow up before I do. All right, all those owner-occupiers that purchased $1 million, $1.5 million, and $2 million properties, they're going to be the ones that blow up, okay? And pretty much the whole country has to blow up before I blow up. All right, so that's that part. Now let's go over to the next section, which is the additional repayment calculator. So what you can see is I've done $3.5 million debt here. I've done a 30-year loan term, monthly repayment frequency, 4% again, and then I've used only 120,000 of that free cash flow, okay, for extra repayment per year. All right, and then I've put 10,000 of that into either the offsets or paying down the debt every month, $10,000. Now, obviously, the more you pay off, the more you can use of that cash flow to pay off the debt. So this is a very flat graph that doesn't increase the payment after certain years. So if you're looking at it, it's going to pay off the portfolio. If I put none of my business debt into the situation, it's going to pay everything off in about 14 to 15 years. Now, if you use a graph that increases the payment, or we start doing more than 10,000 a month, so we do every year we do an extra 1,000 or something, you'll see that it'll pay it off, inside of about 11 to 12 years, give or take. Now, bear in mind, this is also looking at a calculator that, and let's actually move my window across here, so then you can see the graph. All right, a little bit better, and I'll minimize it a little bit so you can see it here. All right, actually I'll put myself up here. All right, there we go. So we've got a 3.5 million graph. You've got the repayments, extra repayments on top of a normal payment, and then obviously I've got a fixed rate of 4% on this. All right, which I think is quite high, because if you look at the 1980s to now, and you plot all of the interest rates along that period, the only direction is that we're going in is down. Okay, it's not going anywhere else. All right, so I'm a big believer that interest rates will be low, and low for a very extremely long time, and we may very well be in negative rates in maybe 2 to 3 years. That's my personal view. All right, so the interest rates that I'm using is very high in my opinion. Okay, very conservative. So if interest rates go back down and the cost of money is a lot cheaper, this portfolio may pay itself off in 7, 8, or 9 years. Okay, so we're not talking about crazy figures here. I'm actually talking about actual numbers. So to give you a little bit of perspective on some of the properties that I bought, 2 units at just over 160 grand a piece. The initial rent that was on it, 205 and 210 a week, but the market rent is 280 a week. 280 a week each, and that's on the low end of the market. All right, so if I put a 10% deposit down, I'm in a situation where my current loan is give or take 145, give or take, and I've got a mortgage, and I've got 280 a week coming in. So if we do 280 a week times 52, we're at $14,560 rent coming in a year. And then if you minus out the strata costs, which is about $2,500 per unit, we've got free cash flow of about $12,060. All right, so if we've got a mortgage of 145, and we divide that by 12,000, we do 12,000 and we divided that by 145, puts us on a gross yield after strata of 8.2%. All right, so that's 2 units that I bought. If we talk about my dual key property, my 4th property, I purchased it for $430, and the mortgage, $430 was the purchase price, and it was a 5-year-old dual key with depreciation on it. And the rent was $290 on one side and $360 on the other. All right, so we're looking at a total rent of $650 on that one. All right, and once the rents go up, which they're just about to in about a month's time, it's going up 60 on each side. So we're going to be looking at 420 plus, and I've got my calculator out, we've got 420 plus 350 equals 770, plus I've got a billboard in my yard that's paying me money, so that's going to bump me up 25 extra per week. So we've got 795 free cash flow per week, times it by 52, $41,340, and then we've got a mortgage initially of about 390. Okay, so we do 390. I'm sitting on a gross yield of about 10.6% with no strata cost initially, and I'm going to pull out deposits and revalue that property up to $700,000 and pull deposits out up to 80% of that. All right, so even if we work out based on $700,000, which is what the new revalued property is at, I'll tell you what the gross yield is. 5.9% on the let's do it on 80% of 700,000, so 560,000. Okay, so on 560k loan size, we're looking at a 7.3% gross yield. All right, no strata cost. I do have to pay water on that property, but I will set up separate connection points soon. So this shows you that the yields that I'm talking about are exactly what I bought. And now we're going to go into some just 5 points on why I think cash flow is so important. So one, cash flow is so important because of your mindset. So right now, so I'm married to the love of my life, Maria. She's a little bit more conservative than me, and even she's amazed at we've got 2 of our properties that are positive right now. The rest are pretty much neutral. And really, she's looked at those 2 offsets, and 2 months after we purchased them, she started seeing the offsets just tick up every month. All right, and then when I told her that once we're done and all these rent increases go through and all these granny flats go on the back, you're going to see every one of those offsets go up this much. And I told her some of the amounts and what the total will be. It really is peace of mind. All right, it's not a negative gearing point market, where money is coming out of your account to maintain the loans and maintain the costs per year of the property, and then you get a deduction at the HEO level every time you lodge your tax. So in me, yes, I'm paying a little bit more tax, but at the end of the day, is it peace of mind? Absolutely. Second one, job security, and if you're PAYG or self-employed, this kind of strategy, even if you're in your rent phase, is exactly what we talked about in the first point. It's peace of mind. You could lose your job, you could change jobs, you could be in a probation period, all these different things you can change around and have the security knowing that the properties are paying themselves off. All right, so you could have a divorce, you could have, go for children and get triplets, and know that these kind of strategies will pay off the property themselves. So even if your living expenses go up, it will pay for it. All right, so that's the second one. So peace of mind, and even if things change with your job or your life, they'll pay themselves off, and you'll be happy for it. So we're in extremely low vacancy rate suburbs. We're talking about the kind of suburbs that have less than 1% vacancy, and there's a rental crisis across this country. So some of the experiences that I'm seeing in Brisbane, I'm putting a property out for lease, and I'm getting 5 to 10 applications within a period of time, which is less than a couple of days. And not just that, some people are offering more rent, some people are offering rent up front. And really, if you look at the housing supply at the moment, it's not going anywhere anytime soon. So we're really going to be in a 3, 5 or 7 year period with a lot of the major cities where there will be a rental crisis. So rents are rising, and I don't like being a slumlord, but I do like having market rent, or just competitive enough to be close to the market. So rents are on the rise, and it's across the country. It's not just one city. So third one, economic conditions. So really, I'm sitting here knowing that the whole country has to blow up for me to blow up, and if that happens, it would have hit me otherwise. So it doesn't really matter. All right, so we're living in times where inflation is 5.2%, but if you look at true inflation, it's over 15%. So I'm sitting on, I'm just about to sit on over $2 million worth of investment debt, and I'm sitting here as if I don't have debt, because inflation really is 15%. So inflation erodes investment debt. All right, not just that, inflation increased rents. So I own assets, and also it inflates asset prices, it inflates wages, all of that. And the more assets you own during these times, the better you're going to be. But the converse effect is interest rates go up. So I'm sitting here, even if rates go up even a full 2%, which I don't think they will, and I'm talking about at an RBA level, not a bank level. So I'm even good right up until 6 or 7% bank level interest rate. I'm good as far as that's concerned. So it gives me peace of mind. All right, so that was point four, the interest rate rises. So you have to understand that when you're doing these kind of strategies, you do have really big buffers, which enables you to hold during bad periods or changes in your life. And really, it doesn't force you into a place where you have to sell when others are forced to sell. All right, and then the fifth one is opportunity for future investment and liquidity. So if you get through a successful ramp phase and you max yourself out, you get into the situation where, if you want to use me as an example, my wealth is going to be compounding and half of it's going to be tax free. So once I'm done, even if we use the lower figures, I'll have about a $5 million property portfolio that's going up 5% a year on average. Okay, obviously you've got big years and small years and things like that, and I think 5% is even a low figure. I think you should be using 7 to 8%, but I'm using 5%. All right, and really 5% is on a $5 million portfolio, 250 grand tax free going up every year. All right, and not just that, I'm never selling a property, so I'm not getting hit with capital gains tax. All right, and I'm in a position where over 350 grand rent is coming in once I max myself out, and that doesn't even include rental increases after I build out the full portfolio and put all the granny flats in. So that's only going to go up over time. Rents normally go up 2 to 3% a year normally. All right, and really it puts you in a situation, and obviously I've got a business and I'm in the top tax bracket there. So really, I've got income going up over kind of 5 to 600 grand total, and half of that is tax free, and if I start putting that free cash flow into stocks, ETFs, super that compounds at 6 to 8% a year, you can see that eventually you can get to a point where half of your income is compounding every year tax free because you never sell. The other half is your cash flow, and then that gives you the availability to have investments and liquidity. So you're the key player that has the money, you have the liquidity, it's coming in weekly, so that you're the person that is the go-to person if someone wants to get a deal done, or someone wants you to buy their business, or someone wants you to become an investor in this or that. You're the key person. So really you're building yourself opportunity as well, and you're the person with high cash flow because that's how you've set up the portfolio. So I hope this video has added a lot of value to you. Really, this is why I invest, and I'm going to be in this situation where I'm maxing myself out start of next year. I've talked about actual numbers that will apply to my life, and really the driving factors for me was to get my wife her end goal owner-occupied property maybe in the next 5 to 7 years, and really the driving factor for me was to have as many kids as I want and not really be impacted on expenses or lifestyle or this or that. So I've really gone hard to a point where I can pretty much do what I want. I want the ability to exit the matrix. I don't want the government telling me what to do or when to do it or how to do it. I don't know if the government's going to change a policy or lock down my business next week. So I want the ability to exit that kind of peril. That's happened to a lot of business owners over the last kind of 2.5 years. So whether or not you're a Liberal Labor supporter or Big Four supporter, I'm anti-Big Four. I used to be a lifetime Liberal supporter, and so is my family, but I'm just disenfranchised on what the government has done to business owners in the last 2.5 years. So really I've gone so hard to get myself into a position where no one can really tell me what to do. But at the same time, I want the ability of choice, all right? Because all I've really done in my life is lending. So the last 13, 14 years, that's all I've done. All right. So most likely, even when I max myself out, I'm still going to run my mortgage broking business, but I may add another one or two loan support behind me. So I do all the front end. I speak to clients. I do all of that, but I do none of the grunt work at the back. That might be a good lifestyle change where it frees up my time a little bit more, and I can give my time more to customers, which I really enjoy doing. And a lot of investors, they like sitting down with someone like me because I'm not just a mortgage broker or a lender. I'm dealing with the banks. I'm classified more as a mentor, because I guess most people that want to get to the situation that I'm in don't have access to a person like me. All right, so they don't have access to a person that's bought more than 6 investment properties and shown them how they've done it. All right, I can't give personal advice. I'm not allowed to. I need to stay on the mortgages, but I can tell people personally what I've done and how I've done it. And then obviously you run that past your professionals and you do what you need to there. All right, so this is really, I call it a peace of mind system. Really, they've seen me buy quite a lot of properties and really quickly, but with how I've done it, it's really buy and then sit and forget. Use your property manager, use your insurance broker, allow them to take a lot of the workload off you. So once I buy it, really I'm just having to manage a little bit more from the expenses front, which Maria does a lot in my life, and then I manage a lot of the lending side of the things. And then obviously it starts becoming a little bit more complicated when we have 10 to 12 different properties in our net bank, 10 to 12 different offsets with money going into each account. So it ends up being like a semi little business with you just tracking the cash flow and then asking questions to the professionals if you don't know what's happened at that specific payment period, or you don't have this statement or things like that. And then Maria, she stays on top of the buying the paying the rates, council rates, insurance quotes with our insurance broker and things like that. So they do the bulk of the work, but Maria tracks a lot of what they do. All right, so really hope that this video has added a lot of value. Hit that like, hit that subscribe button, and leave me a comment if you like these kind of videos. People think that you can't do this in the modern times. They think that lending was a lot easier 10, 15 years ago, and here I am showing you my story, how I'm doing it, why I'm doing it, and showing you the mechanics of how and what the numbers look like. So I'm not really telling you where to buy, but I am telling you, what I've done, what I'm doing right now, and what I'm going to do in the future, and just be open and honest about showing you what's achievable, because I don't think enough people in my situation are giving back and really showing people, what's achievable in the market. All right, now bear in mind that even someone like me with my experience across all sectors, I'm still using a property manager, I'm still using an insurance broker. I've got a buyer's agent myself personally because I'm very time poor with my business. Other people, if they've got a little bit more time, do some courses and things like that and manage it personally, but I don't have that time. So a buyer's agent has been very valuable to me, and my business income is a little bit higher, so I can afford to pay that buyer's agent fee when others maybe not at the start. All right, and really I've got a good accountant, so I build up a team around me, and it surrounds the whole system and it protects me. All right, so really, even I'm coming to you with all this knowledge and experience and skill set, and I'm the guy that's still built a very good team around me. And obviously the more properties I get, the better the team needs to be, and tracking it and making sure that we're maintaining the property portfolio that I've built, and making sure that we're doing it in a right way, a compliant way, and we're doing it for our future, because we're not going to be the ones that sell a property for profit and then reallocate funds here and then rebuy. We're hoping to buy these properties, sit and forget for the rest of our lives, and then pass it on to our kids. That's really what we want to be doing here. All right, so I hope that you've gotten a lot of value out of this, and we'll see you on the next video. All right then, bye.